Anyways, good morning from a balmy Atlanta. It's negative outside, but it's positive in here. Thank you for being here. It is just after 6:30 in the morning, Wall Street time, 3 hours before the open of trading. It's time to get your global macro on at quantbox.co. We're going to look at market sentiment. We're going to look at economic indicators, and we're trying to combine long term with short term. That's not an easy thing to do. But, if you watch any financial TV, if you read any financial newspapers or blogs, they give you lots of opinions. And, well, QuantBox is just the facts, ma'am. Cool. So, anywho, we'll go through all these, drilling into the fundamentals. We'll look at the flow and capital stocks of institutional investors. We'll look at the economic projections by the staff at the major central banks around the world. There's no opinions on QuantBox. We only need to know the facts because it's our job to have opinions. Bottom line is you're going to make informed business decisions, investing and trading based on reality and facts. It's $80 a month, bro. Okay, maybe it's not quite Bloomberg, but Bloomberg is $2,200 a month. QuantBox is 80, and it provides you a lot of amazing information. So just look at all the pretty colors. For example, imagine being able to organize your thoughts before you even looked at a chart. What's bullish and why? What's bearish and why? Where do you want to start first? I mean, if you think about it, in just a couple of seconds, you're looking at, let's say, 35 things you're not interested in trading today. And you just get down to the two or three things you might be interested in. I mean, OMG. So try it, YouTubers. Hey, YouTubers, I haven't uploaded anything to YouTube in probably 3-4 days. Well, if you like the content, why don't you take the trial? It's $8. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term. Never risk money you cannot afford to lose. I have a big development meeting later today. Yeah, looking forward to it. All right, so look, YouTubers, when you pay the $8, you get the macroeconomics course, which is like 16 hours long. You get the QuantBox so you can learn statistical analysis. Nice. And this is where we keep these sessions. There's today, or yesterday, I should say. All right, let's get into the Google Cloud. The magical Google Cloud. It's magic. Okay, 4.14 on the yield. Remember, yesterday we were talking about how this is going to be your gauge of how the market feels inflation, not inflation, but interest rates will be in the future. It's definitely has a relationship with the Fed funds rate. So typically, if the market thought the Fed was going to cut interest rates, yields would be generally falling. Now you're saying, you might be thinking, well, yields have gone up and down and up and down. Well, that's the market figuring out what the next move is. When are they going to cut? By how much are they going to cut? Well, that's all being reflected here. And I believe this is actually lower. This is going to come down a bit at the open. I think it's what? I think it's below 4.1. I think it's like 4.08 or something. So that means money is going into government treasuries. Yeah, cool. Oil, flat. Gold, flat. S&P 500, up. Yeah, up. More up. Very cool. And when the stock market goes up, the US dollar goes down. If euro doesn't do anything, then they do about the same. And you can see S&P 500 up 1/3%, euro dollar up about 1/3%. You see, just okay. And bitty looks like amazing 3.3. Yeah, well, it's down 20 if you want to look at it that way. right? Yeah, down 20 from the top. So you're like, oh my God, look, it's at uh-huh. Anyways, um, big skew there on that. Just an ever so slight tilt to risk on right now on the short run. Pound Kiwi, pound CAD, Euro Kiwi, Euro Aussie, okay, Euro pound Aussie. These are all the same. That the numbers are changing. Some are a little less bullish than they were before. I think Euro Aussie used to be very bullish. So it's come down from, I think it was at 11 and now it's at 8. So there's a change there. Okay. Kiwi Swissy very bearish. Aussie Swissy very bearish. Kiwi dollar very bearish. Aussie dollar bearish. Okay. So these are, once again, things that you might want to take a look at. But this is economic data. This is longer term. Then when you look at the scatter plot, that's the here and now. And so what it's doing is it's looking at these scores, plotting it on the bottom, and then whether it actually went up or down today, which is plotted vertically. Your Wayne, I can see that. Wayne, it's hard to see. Okay, well, you just click on the scatter plot thing. All right, there it is. So now we're looking at the same thing as those tables, but then scoring long-term expectations with short-term reality. Bitcoin way up, and QuantBox has it, slightly bullish, to looks like a 3, and but it is up today and up 3. It's the score and the price change, yeah. But definitely another outlier. Every day it seems like we have to take Bitcoin out because it's either way crazy low or way crazy high. We call that volatility. And for most folks, volatility is bad. So, anyways, if you're on it, good. But like I said, it might feel good to see Bitcoin up 3% today. But if you were down 20, okay. All right. So again, pound Aussie, Euro Aussie, pretty decent performers. Euro CAD, okay. Okay, they're all up 0.5%. But these are all the things that are expected to be up. And correct me if I'm wrong, but I think it was yesterday or the day before, many of these things were actually down here. And we talked about the difference between, is the market reversing or is it dipping? Well, if it's dipping, you're supposed to buy it and move it from bullish to up, right? I mean, bearish to up to bullish or vice versa. Kiwi cat up, okay, shows you like there's been a change in Kiwi and Aussie recently. These were the things that you were selling off. And now Aussie's stronger than CAD. Kiwi is stronger than CAD. So obviously CAD is weak. But the fact that Kiwi's beating something and Aussie's beating something, that's the unusual part of this. If you were looking at it just long-term fundamentals, we all know, because I've shown it before in many times over the last, let's say, 5, 6 trading days, all these things tend to be are at take profit zones. The economics haven't changed, the fundamentals haven't changed, but technically we're at places where traders and investors are expected to take profit, and that's why these dips are occurring. So anyways, that might be occurring on some of these. Very interesting. Let's just look at stock indices only. We'll look at the Chinese stock market through the lens, not of Shanghai, not of Beijing, not of Shenzhen, but through Hong Kong. Yesterday, it became apparent that the government of China was going to do something to not just support the economy, which is crashing, but actually specifically the stock market. And so yesterday we had a swing trading group meeting at 4 p.m. in for day traders and swing traders. And so when we met, I had missed 3 entries on that Hong Kong trade, and it was breaking out. and I'll show you in a second, but it was breaking out and I had missed 3 times. I threw down limit orders, missed it, and it went up. And then it came down. I threw down a limit order, missed it, went up again, threw down a limit order, came down, doing the right thing. That's called discipline. Um, so, anyways, I ended up catching it. And before the announcement, and then it was announced, sure enough, there is a stimulus package coming, and that worked out. So that's why some of those markets, and that might be good for some of the commodity plays, huh? Huh? That might be interesting if you're trading um, anything that's a commodity play. New Zealand, Australia, Canada, and well, by chance, it seems like maybe Aussie and Kiwi are slightly strong today. Ooh, could possibly be that Chinese stimulus package, huh? Oh, for sure. So, anyways, we've lost our underlying, what I've been calling an intrinsic trend, and I like that. It's like the difference between what the price is and what the value is. That's the intrinsic, right? And so I'm looking for trends. My name is Wayne McDonald. I am a macroeconomic trend trader. All right, what's the macroeconomic trend? Niet. So there's still things to do, but this is really important to look at it and say, all right, I might have a relative strength trade today, which is a shorter lived trade. And in this case, probably influenced by the Chinese stimulus package. Um, but am I in a trade that I can buy and hold for 3 months? Not according to this. Could you do it for 3 hours, 3 days? Maybe, maybe. And that's where luck doesn't hurt. Okay. But hope is not a strategy. So just be careful. Just look when you're looking at yen, when you're looking at gold, when you're looking at S&P 500, when you're looking at volatility in the markets, when you're looking at the yields, right? When you're looking at the dollar across 3 time horizons, short, medium, and long, there's no consistency. So be careful. Right. There's not, and it's really important. I was talking to a hedge fund manager yesterday. We were talking about his trades, and he's like, you know what I need QuantBox to tell me is I need correlation data, not so I can find out what's the opposite of the positions I'm in, to find the things that have no correlation with the positions I'm in. I'm like, oh, right. And so it's kind of like, wouldn't it be a gauge to say, well, if you were long this pair, this other pair has no statistical relationship, right? So this is showing us there's no statistical relationship amongst these assets to whatever you see is going on in the market. I call that trend. But boy, I think this could be interesting if I produce something like that where you could look at correlated data, but in specifically maybe non-correlated, because there's investing, then there's hedging, but then you want, most hedge funds are looking for non-correlated investments. So that's interesting, right? So who knows? Maybe we can build something like that. So intrinsically, there's no trend. Yeah. So be very careful, right? So when we go back to here, these are all the trends, but we don't have, they're not, it's not trending now, the market. Okay. So, anyways, we can go back to these. This is the long-term economic reality, but things may be changing. So you look at the commodity plays now, Kiwi, CAD, Aussie, they've all been very weak. If you do the reverse of all of that, you can see on this side, the bearish stuff. If I can grab this. Oh, there we go. You can see Kiwi, Aussie, very, very weak. CAD, very weak, right? So those commodity currencies have been weak. It's possible that changes now. Fundamentally. So let's do a cross pair here. Excuse me. What do we want to pick on? Euro's neutral. I guess we'll do a euro kiwi. Euro was neutral when we looked at the dollar. Okay. So this has been going up. Look at this score. The economy is no good. Buy it. Yeah. Um, yeah. Interest rates paused. Interest rates paused in both countries. Okay. Inflation. Look at that, huh? Inflation in New Zealand is still around 5%. Yeah, it's falling, but look at compared to euro. Whoa. GDP, a negative number? Wowzer. Okay. Interest rate. Okay. We're scoring it as a zero. And maybe I'll ask the development team today in our meeting, why isn't this a plus one? And I'd have to double check in the scoring. It might be required to be greater than a 1% interest rate differential, because a 1% interest rate differential is not a carry trade, right? I'm making a 1% carry, but you're losing 5% in inflation, right? So anyway, so it's not technically a carry. But interesting. You could score that a one if I wanted to. Heavily short. Okay, retail's heavily short. Okay, there's a bit of a long bias on the euro. So, retail doesn't have it quite the same as institutional. Very cool. So here's the thing. Um, does QuantBox know there was a change in economic policy in China last night? No, that hasn't had an impact on inflation, GDP, unemployment, interest rates. So and it wouldn't influence what usually happens this time of year, because, okay, so we need a few weeks to start seeing if, like, the only thing that would read into this, because remember, you have to say, oh, because China is now stimulating their economy with almost $1 trillion, that should improve the economy in China, which then should increase domestic demand for commodities, and they may not be able to supply it domestically. So then they would have to look outside the border to find things like iron ore, coal, and wheat. And iron ore, coal, and wheat is found in Australia, and that's not too far from China. So therefore, or milk, dairy products, and lamb, comes from New Zealand. So okay, sometime, right? So somebody somewhere, just like me last night on Wall Street, said, "Oh, that's going to favor the New Zealand dollar. I think maybe I will make that play." And then that has to get reported. What day is it? Wednesday. So it won't get reported this week. So you won't see it in this week's COT, which is Friday afternoon around 4. So it's the week following. So not this Friday, next Friday, you might see a change in demand for Kiwi dollar. So you can wait for the report, or you can make assumptions, which is your job. That's your alpha, to be able to read what all this is, read between the lines, and make your investment. And then eventually we can confirm or deny it with facts. So you got to start with your hypothesis. Okay. This time of year, this pair is pretty flat, especially over the last 5 years. This, right, pretty flat. So anywho, this in the next couple of weeks could be not very bearish or bullish. You see, it's very, very, very bullish now, or has been, I should say, very, very, very. But that might just have ended. That might be done and dusted yesterday's news, but you should know. It doesn't change anything economically quickly, but there are market forces at play that could be changing. So let me just illustrate that with the trade. And again, I think this was my fourth iteration of trying to grab this yesterday. I missed this one. I missed this one, but I got that one, right? Like building the castle swamp. Do you know that one? They said I was daft for building a castle in a swamp. It fell down and sank. I built another one on top of it. It too fell down and sank. The third one caught on fire, burned, fell down the swamp. But the fourth one, yeah, Monty Python, y'all. Monty Python. So, anyways, one of the Chinese stock markets, I caught it at 15.5, 15 and a half, kicking off of a moving average. And Hold'll, hang on for dear life. And later this morning, or earlier this morning, I should say, I moved my stop to break even. I could leave it here, but yeah. So yeah, nice little role reversal, huh? Pretty straightforward. And check it out. So I did it yesterday at the US close. I threw down the limit order on the roll reversal. And then you can see Asia open. The news was announced, gone. So now what? Yeah. Well, does this have a positive impact on the Australian stock market? Seems to be a positive correlation, candle for candle, huh? So do you think people expect Australia to do well on the Chinese stimulus package? Yeah. So could that be a demand for Aussie dollar? Well, in the beginning, it's a demand for the Aussie dollar because we're just trying to make money on the news, the change in the economic situation. But if China actually does need to buy iron ore and coal from Australia, remember, iron ore and coal are Australia's number one, number two exports. That's where they make their money, honey. Yeah, gold too, but gold as a percentage of GDP. Yeah, but the ounce for ounce, okay, ounce for ounce, they sell a lot more iron ore and gold than they do gold. But it just happens to be 1 ounce of gold is $2,000, and you can probably buy several tons of coal for that. But nonetheless, the major exports are iron ore and coal. So if China wants to buy that, then they're going to need Aussie dollar to do the deal. You're also probably going to start seeing this like in the next few days. Let me give you some alpha. Okay, if this is happening where suddenly the Chinese economy is stimulated and the department heads of companies or states or whoever suddenly realize, oh my God, we're going to need some iron ore and coal. We're going to need some wheat. We're going to need some soybeans. They need to call those companies, place the orders. They're going to need to catch the right amount of Aussie and Kiwi dollars to because the deals are not priced in Chinese yuan. But then they got to get the product from Australia back to China, right? And so while we wait for the COT data, you should also be able to confirm that all of this is happening with the Baltic Dry Index. Now, this is an index of the price of the ships. So if you buy soybeans from Brazil or iron ore and coal from Australia, this is the ship that brings it back to you. So you buy Aussie dollar to buy iron ore. Now you got the iron ore, but now you got to bring it home. So now you need a ship. You got to call the shipping company. They also need Aussie dollars, right? So, anyways, this is an index of the price of those ships. Cool, right? And prices currently are fairly low, half of what they were recently. Okay. A year ago, they were 60% cheaper, but a few months ago, it was double. That's a lot of volatility, right? But if you start to see the Baltic Dry Index start to rise, that's going to be what we call a high frequency data confirming the Chinese stimulus package on the commodity market, which then in turn, because the commodities are exchanged for money, the foreign exchange. So you might be a foreign exchange trader, but you have to understand the supply and demand for wheat and soybeans globally and the price of shipping. Hey, it's not boring, is it? Hey, what'd you do today? I bought some Nvidia stock. Why? It goes up. That's what other people do. You have to put this narrative together and you're like, wow, this is so much more interesting. Okay, cool. So anyways, so that from me to you, that's my gift. So that could possibly play on the market in all kinds of ways. If the Chinese economy stabilizes, maybe they buy more BMWs, stuff like that. Who knows? There's a lot going on. Cool. All right, so that's good enough. I think we covered the fundamentals. We covered a pair. We covered the news, and we covered a trade. I think that's a pretty good morning. So thank you for being a subscriber to QuantBox. I appreciate you. Yeah, and if you're watching a delayed recording on YouTube, hey, join the group. So peace on earth. May the pips be with you. May our profits be above average. I'll see you when I see you. Cheers.